In this video, I'm going to cover mutual funds and investment diversification. A mutual fund refers to a managed collection of cash, stocks, bonds, and other securities. Mutual funds can be classified as open-ended funds where there's no restrictions on the shares that can be issued, or closed-ended funds where there are restrictions on the shares that can be issued. There are a variety of different types of mutual funds. A money market fund invests in short-term securities such as U.S. Treasury bills. These funds would provide liquidity, and they'd also provide a higher rate of return than a savings account. A fixed income fund would invest in bonds or certificates of deposit, and equity funds invest in stocks. There are different types of mutual fund equity funds. An index fund aims to achieve a return that meets a particular market index, so it would track the performance of a group of stocks. Income funds refer to funds that invest in stocks and pay regular dividends. And growth funds may not pay regular dividends on a regular basis, but they're a good investment if you're looking for large capital gains. Balanced funds will combine stocks, bonds, and sometimes they'll have a money market portfolio. These types of funds will help to even out the volatility that can occur within a fund that just invests in stocks or equities. So how does a mutual fund work? The mutual funds are operated by a fund manager, and that manager will pool investors' money together and then invest in stocks, bonds, money market instruments, or some combination. If you invest in a mutual fund, you become a shareholder of that mutual fund company. You invest through the fund either directly or you could purchase them through a broker, for example. Dollar cost averaging is an investment strategy where you're putting a consistent dollar amount into the investment at regular intervals over a long period of time. So in essence, you would allocate a certain percentage of your paycheck. In every single pay period, you would put that percentage in the investment account. Mutual funds can pay dividends on the stocks. They can also pay interest. There are capital gain distribution. That means when the fund decides to sell a security that's increased in value, that increase would result in a capital gain. A net asset value, or the book value, refers to the market value of the fund minus any expenses of the fund or liabilities. The book value can also be expressed as the price per share. A no-load mutual fund is a mutual fund that does not charge a sales charge or commission rather. Why would you want to invest in a mutual fund? A mutual fund gives you professional money management. So you have a full-time manager who resources and makes and monitors the investments. It's simple. The minimum investment that you can make in a mutual fund can be small relative to investing in individual stocks on your own, and you're getting economies of scale. Transaction costs for buying and selling are lower for fund managers because they're trading large amounts of securities. Because the funds are made up of many different types of investments, you're getting a lot of diversification, more diversification than you could likely achieve on your own. Mutual funds give you liquidity, meaning the shares can be converted to cash at any time. And capital gains distributions refers to the funds may pass on the long-term gains in the forms of distributions at a lower tax rate than normal income tax. You want to be sure before investing to analyze the fund's performance. So how has the fund performed over time? You can read what financial experts are saying. You can research the fund manager. You can research or read the prospectus, which is a a report that outlines the fund's strategy, their goals, and also the fees. And you can compare using consistent measures. Diversification means you're investing in different companies, industries, and asset classes. An asset class refers to a group of investments whose prices tend to move in the same direction. Investment risk refers to the uncertainty that you're going to achieve some sort of return over time. Asset allocation is important, and that's the process of determining what percentage of your investment portfolio are you going to have dedicated to different asset classes. So in other words, how much of your portfolio is in stocks and how much of your portfolio is in bonds. And in general, the younger you are, the more risk you can afford to take. So therefore, the more of your portfolio you would want dedicated to stocks. There are also alternative investments to consider. Precious metals, commodities, something called hedge funds, which are a pool of investments that are not regulated by the SEC, real estate, or collectibles. You want to consider various economic factors when considering investing in financial markets. So you want to consider inflation, interest rates, what's the employment outlook, and what's the projected economic growth. Are we looking at a recession or at a time of expansion? Some basic economic indicators are gross domestic product, which looks at the value of goods and services in a country over a specific period of time. Consumer confidence index, so are consumers optimistic about how the economy is doing or not? You want to consider the consumer price index, which looks at inflation. The consumer price index is the most widely used measure of inflation, and that can have an impact on how your investments would grow over time.